Welcome to This Explainer. Today, we're taking the foundational math of finance and turning it into an intuitive toolkit. Honestly, if you've ever stared at a performance dashboard and wondered what all those percentages are actually telling you, well, you are definitely in the right place. We're going on a fascinating journey through the mechanics of rates and returns. We're going to peel back the layers on how money grows, how risk is priced, and how performance is actually measured out there in the wild.
Here's our roadmap for today. We've got 5 stops. 1. The anatomy of interest. 2. Measuring your baseline return. 3. Averaging the right way. 4. The cash flow complication. And 5. Real-world return adjustments.
All right, let's jump right into Section 1, the anatomy of interest, unpacking the rate.
So, an interest rate isn't just one single concept. We can actually view it through 3 distinct lenses. First, it's a required rate of return. That is literally the absolute minimum percentage you demand to even consider handing over your capital. Second, it's a discount rate, which is the mathematical tool we use to translate a future pile of cash into today's dollars. And third, it's an opportunity cost. It's exactly what you're giving up today by choosing to invest instead of, say, spending that cash on a great vacation.
Let's build one of these from the ground up. To construct a real-world nominal interest rate, you don't just pull a number out of thin air. You start with a base, the real risk-free rate. That's your pure compensation for delaying consumption. Then you start stacking distinct risk premiums right on top of it. You add an inflation premium, so your purchasing power doesn't just evaporate. You slap on a default risk premium, just in case the borrower goes belly up. You add a liquidity premium if the asset is tough to sell quickly. And finally, a maturity premium to cover the sheer uncertainty of tying your money up for a longer period.
Moving right along to Section 2, measuring your baseline return, the holding period. The fundamental building block of all performance measurement is the holding period return, or HPR. This is your baseline. And what's absolutely crucial here is that it captures the total picture. It doesn't just look at whether the asset's price went up or down, because that's just your capital gain or loss. It also includes any income the asset generated while you held it, like a stock paying out dividends or a bond paying interest. It's the whole shebang.
Picture this in action. Imagine you buy a stock, but the price actually drops over the quarter. So you've got a capital loss. But you also receive a pretty healthy dividend payment. The holding period return calculation combines these 2 factors. The income from that dividend partially offsets your capital loss, revealing your true overall return for that single period. It really is the ultimate reality check for a single investment time frame.
Section 3, averaging the right way, beyond the basics. Because look, a single period is easy enough, but what happens when we invest over multiple years?
This is where people get into trouble. You have to understand the difference between the arithmetic mean and the geometric mean. If you want to estimate what might happen in a single hypothetical future period, the simple arithmetic mean is your best guess. But if you're looking backward at historical performance across multiple years, you absolutely must use the geometric mean. The geometric mean accounts for the way returns multiply over time. It measures pure compound growth.
There's this golden rule in finance. The geometric mean is always less than or equal to the arithmetic mean. Why? Because of the mathematical drag of compounding volatility. Think about it. If a stock drops 50%, it takes a 100% gain just to get back to even. Your actual geometric return, the money that's actually sitting in your account at the end of the day, will always trail the simple arithmetic average, unless there's absolutely zero variability in your returns.
So, if the geometric mean handles compounding over time, what tool do we use for more complex averages? Like, what if you're applying a fixed amount of money to varying asset prices month after month, like your 401k contributions? Or what if you want to find the average price-to-earnings ratio of a whole portfolio?
Enter the harmonic mean. When you invest a fixed amount of money regularly, which is called cost averaging, you naturally buy more shares when the price is cheap and fewer when it's expensive, right? If you just took a simple average of the stock prices, you'd be heavily overweighting those expensive purchases. The harmonic mean is your specialized tool here. It perfectly smooths out the math to tell you the true exact average price you paid per share.
Okay, Section 4, the cash flow complication, money versus time. Because in the real world, investors don't just buy an asset and sit on their hands.
They constantly deposit new funds and withdraw cash. This splits the world of returns into 2 distinct camps, the money-weighted return on one side and the time-weighted return on the other. If you want to know how the investor's specific deposit timing affected their total wealth, you use money-weighted. But if you want to judge the underlying fund manager's actual skill at picking investments, you must use time-weighted. The manager can't control when the client deposits or withdraws their cash, right?
Let's break down the money-weighted return. It functions exactly like an internal rate of return. You lay out all your cash outflows, like your initial investment and any new deposits, against all your cash inflows, like dividends and withdrawals. Because it weighs the cash, timing is absolutely everything here. A terrible market drop stings a little if you only have $100 invested, but it is financially devastating if you just deposited a massive lump sum the day before.
To strip away that timing luck and calculate the time-weighted return, we follow a quick 3-step process. First, we break the timeline into subperiods at every single cash flow event. Second, we calculate the holding period return for each individual subperiod. Finally, we geometrically link those returns together. This gives us the pure compound growth of a single dollar invested on day one. It completely neutralizes the noise of when the client moved their money around.
All right, our final stop. Section 5, Real-World Return Adjustments, Taxes, Inflation, and Leverage. We've got the math, now let's apply some real-world friction.
Whenever someone hands you a return figure, you always need to read the fine print. Returns need adjustments to actually mean anything. First, is the return annualized or maybe continuously compounded? An 18-month return has to be scaled down to a yearly metric so we can compare apples to apples. Second, is it a gross return or a net return that subtracts the manager's fees? And most importantly, is it an after-tax return? Because at the end of the day, you only get to spend what the tax man lets you keep.
And speaking of what you actually get to spend, we have to talk about the real return. A nominal return of 8% looks totally fantastic on paper, but if inflation is running at 6%, well, your real return is barely scratching 2%. The real return strips away the illusion of inflation. It's the only metric that matters if you want to know whether your investment will allow you to buy more goods and services today than you could yesterday.
Finally, keep in mind how leverage plays into the whole equation. Applying leverage to a portfolio, whether through borrowing money on margin or using futures contracts, is a profound double-edged sword. It doesn't just increase your risk, it mathematically amplifies your final return. If the market goes your way, you get a massive amplified gain. But if it moves against you, you are looking at a crushing amplified loss.
The beautiful math of finance is completely useless if you apply it to the wrong scenario. So the next time you look at a dashboard, a prospectus, or a performance report, stop and ask yourself, what exactly is that percentage measuring? Are you looking at a single period or a compounded history? Are you evaluating a manager's skill or just the luck of your own timing? Choose your return measure wisely. Thanks for joining me on this explainer, and keep questioning the numbers.